Do you see big divergences in where Germany is in this and where other European countries are right now? Does that dictate anything about your short-term investment strategy at this point? I'm talking about the handling of the coronavirus pandemic. How is that impacting on your investment strategy? Or do you look entirely through this winter and focus on the spring?
I think that's a great question. I think the market's grappling with that at the moment, Anna, because you've had all this good vaccine news out over the last couple of weeks or so, yet we know that over the next few weeks, at least in the short term, we're unfortunately likely to see coronavirus cases pick up and hospitalizations pick up. So for us, it's managing both the short-term impact, which should be supportive for fixed income assets and for keeping yields low, and then looking through that to hopefully through the spring and into the summer of next year, which looks like global growth will pick up, and that should be supportive for risk assets. So I think having a combination of both at the moment makes sense, and that's really how we're managing our portfolios.
OK, and what kind of support do you think, what's your assessment as we watch the way the different countries handle the Christmas period, the holiday season, through the tough winter months? What is your assessment of what kind of support needs to still be forthcoming, whether that's fiscal or monetary? Where's the emphasis for you?
I think we're definitely going to be getting more monetary support. I think the central bankers have made it very clear that they're looking at what will be happening in the near term. We've obviously got very important meetings before the end of the year from both the European Central Bank and the Federal Reserve. And the expectations is that at a minimum, we will stay where we are from a monetary policy standpoint. But we could, particularly in the case of Europe, actually be increasing the programs to continue to support the economy. So that's going to be very good. That's going to be very good for pretty much all assets, both fixed income and riskier assets. The fiscal side is obviously a much more interesting question, because we know some of the fiscal programs that are in place in the US are starting to roll off, and we still have got gridlock over there at the moment on discussions around the next package, and it may well be that we need to get into the new administration for that to come through. So I think it will be monetary policy that does the hard work, at least over the near term.